All right, what's up, guys? How you doing? I want to make a video today on a topic that I don't think is really touched upon enough, and can really help improve your understanding of the direction of the market, and that is understanding market structure. So, market structure, I guess, really in simple terms, can be: are we in a downtrend, or are we in an uptrend, or are we consolidating? What's going on? And knowing this will help in turn let you figure out how to position yourself, or know when your trade can be invalidated. All right, so to dive into market structure, let me first go over a key detail that I think people need to understand, and that is that institutions, whales, market makers, whatever you want to call them, the people with the most volume and liquidity in the system are the ones that drive the market. And the best way to know when the market is shifting is to understand where they're bidding and where they're protecting and where they're not. So, starting off, let me just highlight a couple areas. So, if you see something like this up here, so we have this. Oh God, what am I doing? So, we have this area right here where we had some uptrend and then a strong reaction to the downside. Obviously, this was institutionally sponsored. The majority of institutional investors, smart money, wanted to push the price action to the downside. And you can look at this really just by reaction to certain directions. So another way to really look at things is like there was some reaction here, but it really wasn't that strong. It was still, price action playing out from here. So I don't know if I would really count this as a high, as like a market structural point, a market structure high. But then you can see as we move on down here, we had a very strong reaction to the downside after a swift move up. Now, this could be another area where you could see institutions were obviously protecting and they didn't want price to go higher than this level into this region, or a chance to get back up into that previous high. All right, so the two patterns I want to point out before we start going into the price action and actually trying to chart out where we can see shifts in structure is just knowing whether you are seeing a valid market structure break or if you're just seeing a swing fail pattern. Now, I didn't come up with either of these terminologies, something I kind of just learned through little courses I took and things like that. But it's really helpful in seeing how price action reacts off a valid, in this scenario, a lower high. So at first, for a swing fail pattern, let's say we have a lower high and we see price trade up just briefly through it, and we get some wicks, maybe some lower time frame candle closes, but then we start seeing just a strong reaction to the downside. This right here is the market makers grabbing liquidity off of a previous high and getting breakout traders in there taking, in this situation, taking shorts out. This is just a liquidity grab. Now, you need to watch out for these. It's pretty easy to kind of see it as price action develops if this is just a market maker liquidity grab, or if this is a valid change in market structure. Now, a valid change in market structure can look like this. So if we had valid, in this downtrend, lower highs and lower lows, and we had a swift break with very little resistance through a previous lower high, candle closes on higher time frames, into, let's say, this other supply area, whatever the case was. This is when you can start looking and seeing that potentially we're starting to see market structure shift from a downtrend to an uptrend, or from an uptrend to a downtrend. So knowing these two patterns will really help you understand, how is the market maker thinking? Are we just grabbing liquidity to continue on downward? If you see this, we're most likely continuing on downward. If you see an actual market structure shift, that's when you can start changing your trading strategy from maybe going from short to a long position, or getting out of your trade, or whatever the case is. Knowing these two patterns will help you substantially going through, looking at price action. So without further ado, let's dive in, and I'll show you on a lower time frame and up to a higher time frame how these patterns look on real price action. All right, so I'm going to do a playback and just start going through market structure on this lower time frame. We're just going to be on a 2-hour chart, and go through and see where we can spot valid institutional sponsorship of market structure and watch to see if we get a break of structure in any sense. So you can see right here, we had a very quick reaction to the downside after this little move to the upside. So this, you could tell, is sponsorship induced by the institutions. So this is a valid, you could say, supply area. You could say resistance area, whatever you want to call it. But this is an area of lots of supposed resistance because of how much we moved down after this up candle. So let's let it play out. And you can see we break through that no problem. There really isn't much, we're getting 2-hour candle closes above here. You could tell it wasn't a swift reaction more to the downside. So this is where you could probably see that most likely we're going to maybe have a shift in market structure. So this is now becoming support in some senses. So as you can see, we went from a lower high to a lower low to a now higher high off these valid market structure conditions. So as you can see, we had another higher high in a sense. You can count this as being a lower low. It's not the strongest reaction, I would say. It's not definitely institutionally respected. You can see there definitely is some reaction, but it wasn't like the rejection of this candle or the rejection of this candle, whatever the case was. So we can just leave this right now as this being the higher high. So we're going to now look to see that it's a low, but not institutionally sponsored. It wasn't such a swift reaction as you see in the other ones. And once you see something like this, you can figure this most likely just being a swing fail pattern. Now, the reason why that is because we didn't have really any candle closes below here. We just had wicks with a strong reaction to the upside afterwards. So most likely we still are in an uptrend. So you could still mark this out just as a swing fail pattern. And this would be the lower low or the higher low. This would be the higher low. All right, so continuing on, you can see that this is another area of somewhat institutional sponsorship because we had a pretty strong reaction after this downside. And any break of this strong reaction can constitute for a potential shift market structure break to the downside. Okay, so you can see this is institutional sponsorship as well. So you can call this a higher high. And now we're going to watch and see if we get a lower low. So as you can see, price action is acting a little bit different than what it did over here. We have this low being broken right now. You can tell there's more than just candle closes or just wicks. We have now candle closes. We had stagnation instead of a swift reversal like we did in these areas. And this is actually like live right now. I can't go any further. And we'll let this play out and see what happens. But as you can tell right now, we're most likely creating a lower low of some sense. And once you see that, you can look for potentially entering into a short position on some sort of retest or any pullback of any sorts, you can start targeting liquidity throughout now that this uptrend looks like it is now reversing. So you can go through targeting, a supply area, a previous breaker of some sort, up here if you want, whatever you see price reacting to. You obviously don't want to just get in on a breakout because that's when you're most likely to just get wrecked. Do not play the breakout game. Trust me, please. So as you can see right here, this is a quick overview of when you could see institutional sponsorship through the reactions. When you can spot that, then you can start marking out the direction that we're going. So either we have lower highs, lower lows, or higher highs and higher lows. And once you can spot those, and you could tell what direction we're in. So are we moving to the downside or are we moving to the upside? Are we in a downtrend or an uptrend? And then using the two patterns of swing fail patterns or a market structure break, then you can really determine what the intention is of the market makers, the smart money, and the liquidity providers. Although I'm using this on a 2-hour time frame, it's all fractal. So basically, obviously, there's a hierarchy to it. So the daily chart will take precedence over, the 4-hour chart, over the 1-hour chart, over the 30-minute chart, and so on and so forth. But overall, the concept still remains. If you see right here, so we have, break of structures on this daily time frame with, from higher lows to higher highs to lower lows to lower highs to breaking down. And the same thing is set forth over here. So as you can see, it's all fractal. It doesn't matter really what time frame you're using it on, but the only thing to keep in mind is that higher time frames take precedence over lower time frames. Just wanted to point that out. So with that being said, I hope this helps in some way. I don't want to make this video too long, so I'm going to edit it up right now. But I do have some other videos coming out in the next couple of days. I've been trying to spend some more time and get my point across correctly instead of just trying to push out content. I like things that I actually watch back myself. Hope you guys like this video. Let me know in the comments if you had any questions. Hit me up in the Discord or Twitter, whatever the case is, and have a good day.